All right, so we have a buy sell liquidity pool is high, rejection block. These are the objectives I'm looking for if I'm correct in my assumptions that the dollar index should go lower. This would allow cable to rally higher. And if it does, this is what I'm reaching for. Okay, so it's a pretty significant price run. I'm thinking that we traded down to this down close candle, which is a bullish order block. We also traded back into this old high, and we reacted, pretty nice off of that. So we have a small little range here. Anything bullish from here should see a large range form. A fair value gap like this high and this low with this one single candle. So in other words, if you draw this line out over here and this here, between this two price points here, this is an imbalance of only buy side. You're going to anticipate at a later time price eventually coming back down into that because it needs to offer sell side. It offered buy side with the market going up. A fair value gap is a deferred rebalance, meaning that when it forms, it'll take time for it to eventually get rebalanced. There is something that I'm going to teach you now that's called an immediate rebalance, and that's seen by here. We have a candle's high. The next candle we trade above the previous candle's high, and in the next candle we open higher than the previous candle's high here, and then we trade back down into the previous candle's high. So there is no fair value gap here. It's an immediate rebalance to this candle, whereas as I was outlining this candle's high in the relationship between this candle's high and this candle's low, the range is seen with just one up candle moving up between this candle's low and this candle's high. So your eye is being trained to look at just this little portion of price action and then eventually expecting it to trade down here at a deferred time in the future. If the market has a high and the next day we trade above that high and the next day we open above this candle's high, if it trades back down to this candle's high, this is an immediate rebalance. So this is something that I watch intraday, and if I watch, and this is why I also teach you to look at the last 3 days. That this is the secret why I teach it in my YouTube channel. I tell you to look at 3 days look back all the time. This is the reason why I tell you to look at the last 3 days for immediate rebalances. So the opening on this here, if we watch this on a hourly chart, because this is a monthly chart, it's the same thing. So if this hourly chart closes here, the next candle opens here, and we trade down to this candle's high here, that would be a buy right there for me. If I'm already bullish, I would be in there all day long at that, buying hard and anticipating a range expansion on the upside. This is what we look for in rebalancing. And once you see it, as long as you have the context correct, in other words, what you think you're seeing is bullish or bearish, I'm either waiting for a deferred rebalance with a fair value gap, or I'm buying an order block or selling an order block, or I'm trading off of an immediate rebalance into a liquidity pool above an old high or below an old low, or into an imbalance. Now, I could be, say I'm in this here, and I'm basically bearish, or I'm indifferent to the market. I just don't know what I want to do, but I see something at this opening price that looks bearish. I could sell short this market and aim for this candle's high. And that would be also trading with the immediate rebalance in mind and not holding on to the position too long. All right, and the weekly chart for pound dollar. All right, so we have the buy side liquidity pool, as I mentioned before. We have a rejection block. Why this one and not this one? Because we have a higher high here. So this is a stop run, and you use the initial high because that's your real high, and this is a run for liquidity. So this is the one they priced in. This is the one they take the traders out of, so they can't participate in the context that was formed on the initial high. So the up close in that swing high, extend that out in time. That's your rejection block. I think it's going to trade there if we continue higher and lower in the dollar. We have a breaker here. Now, why is this down close a breaker? Well, like I showed you in regards to a mitigation block, mitigation would have a high, a low, and a lower high. We don't have that here. We have the high, the low, and the higher high. So that makes the down close candle that's lowest in between those two highs a breaker. And we've been banging on that here a few times. Now, the fact that we have not shown any real sensitivity and hard sell-off from there leads me to believe that we're probably going to press up higher. And it might do so with a big candle. I think that this is possibly going to drive up into the order block here. These last two up close candles prior to this run lower. That's the order block, this low, extending out in time. That's what the negative OB stands for. Hourly chart on cable. All right, so you have the buy side liquidity pool here. Mean threshold of the last up close candle, bearish order block, which is being annotated here. It hits it here. Rejection block. This closing price, not this one, because this one runs through this high. So extending out in time, we trade through that rejection block and an old high here too, and runs lower. Back to the 28th, we have the market trading down to order block, rallies up, and we have a projection block. Okay, so we have an order block, another candle that's on top of this order block. We don't want to see it trade through 50% of the order block. That also confirms the projection block. And we have a buy side imbalance, sell side inefficiency here. And we have another one here to here. The market runs up, hits the order block, trades lower, trades back up into the bearish order block here, sells off, closes into buy side imbalance, sell side inefficiency, mean threshold of the projection block. This candle's high, this candle's low, split that in half, projection, mean threshold. Trades to it here and trades into the rejection block of this closing price. Why this one, Michael? Because this went lower than the previous one. And then we had this big price run. So this drop down was a run on stops below this low. So the lowest down close, that price is your rejection block. So we have convergence of mean threshold on the projection block, rejection block, order block, all in here. So price runs up one more time and trades up into the mean threshold of this bearish order block there. Sells off and closes in the buy side imbalance here. It works again the breaker level. And that breaker level I showed you on the daily chart. So you can see all of the work in that breaker. It hasn't collapsed yet. And this is way too many times for me to be seeing a trade back into a breaker and not go down significantly. It just feels like, okay, it goes up here, it starts to break down. Okay, start selling short. Boom, they knock them out. Okay, starts dropping down. Okay, now it's really time to start selling it. And they sell it, and then boom, they knock them out one more time. Okay, now it's starting to drop one more time. Now it's definitely time to go lower. And then they're really going to ram it higher. That's how I would do it if I was making the market for cable. It just looks like, you know, they have all these reasons in here to see resistance. All right, so 15-minute time frame on cable. All right, so we have the sell side liquidity pool, optimal trade entry in here. Runs up, creates a buy side imbalance here. That projection block, the levels have been transposed into the 15-minute time frame. Inside that BISI, the higher one, remember this is the lower one and this is the higher one. Inside the uppermost one, you can see now we have a more refined imbalance with the fair value gap. This candle's high, this candle's low. We have that candle right there only moving up. Just one candle portion right here. Extending out in time, we have sensitivity at the consequent encroachment. Rallies up to a bearish order block. Breaks lower. Hits the order block, last up close candle in here. And consequent encroachment. All the conversions with a buy side imbalance, sell side inefficiency, fair value gap. What am I saying here? We went up here with this candle to be efficiently balanced, to make it a perfect, efficient market. It needs to come down. Does it fully go down into it here? No, it leaves this portion not traded to. It rallies up and then it trades down here. Trades away from it. Now it becomes a balanced price range because we went up, down halfway, down through all the way, came back up, moved away from it. Now it's going to be resistance. See the logic there? Versus, oh, this is the old low broken turn resistance. Well, I can show you 1,000 of them things in price action where it should have done that. It doesn't. But when you have the logic that I'm outlining here, that's narrative. That's what's missing from retail logic. If you add retail logic to any old chart, you're going to lose. But you have to have an understanding. Why should it go here and trade lower? Well, from a resistance support idea, it's going to be, okay, support broken, turn resistance. So where's it going to go? Well, it's going to go down to this low here because that's support. Well, why did it go right to here and turn around and go up there? Because it filled in all of this rebalance that's necessary on the buy side. It went down and offered price going down. So it's the same paint roller analogy. Apply the paint to the canvas and then come back down to make sure that everything you painted here has a rich delivery of paint. Then you can go higher again because you've done the work here. You painted up, come back down, filled in any little pockets, and then went back up again. But it's reacting off of the imbalance that's seen here. Hits it, rejection block, projection mean threshold, sends it higher. Breaks lower, small little fair value gap there, candles low, candles high, that little piece of action going down. How does that get rebalanced? It has to be traded up to and through it. No, not through it, but to it. Here on the upper end of the fair value gap. And then look at the bodies of the candles. Yes, you have a lot of these little wicks in here. That's all broker based. But look at the bodies. They're respecting this gap. This right here is sensitive. This has always been in your charts and you've never noticed it. Now you're starting to see it. You're seeing how often it forms. Then you have another displacement, goes lower, creates another fair value gap right there. It's not annotated, but it's the same thing here, right there. This candle's low, this candle's high. Look at the bodies filling in just to that point right there, and then there's a drop. That's a trade. That's a scalp right there to get just below this low. Selling short in here to run to this low here. At or just below it, and it hits it, boom. And there's the imbalance that's on your hourly chart again. It fills that in. There's all kinds of trades in this very chart that I'm showing you right here. On a 1 minute chart, you could be all over the place in this thing. But you have to have all this logic on your chart at the time working with it. What does that mean when I say that? When I say stuff like, when you find your model, your niche, what does that mean? Well, this could be a model where you see a run up in price like this. It hits a level that would otherwise offer reasons to sell off. And then when you see price create a low, a break below it, and then there's an imbalance that comes back up in, and then it sells off. So if you know you have an imbalance that closes in with this line right there, and you want to sell off here, what is your framework? You're selling here, and you're trying to get down here. So you can sell short here and buy it back about 5 to 10 pips before you get to that low. Period. End of story. That's your trade. Is it 1,000 pips? No. Is it 10? Yeah. But if this same pattern forms on an hourly chart or a 4-hour chart, this range could be 30 to 50 pips. You see how you can scale this? And you're thinking probably, oh, this only works on these lower time frames. No, it works on all time frames. All right, 5 minute chart. All right, on the open kill zone, creates the low of the day. How incredible is that? We have a run higher, traded lower. The price run here creates an imbalance. Then we have that buy side imbalance, sell side inefficiency, and fair value gap on the 15-minute time frame, which becomes this little fair value gap on the 5-minute chart. So it gets even further refined here. And then we have price running up, creating the high in London close, but then ultimately trading higher post 2 o'clock in New York time. I want you to take a look at this area in here and consider what might exist in the dollar index at that area. If you look at the dollar index, this orange line here, I've overlaid the dollar index. Now look what's happening here. You have the high and then a higher high in the dollar because it's a mirror image of what you see in euro. Well, watch what happens here in euro. We have the low And then we have the lower low, right? No, we don't see a lower low than this here. After this low, it's higher, higher, and higher. Well, the high here in the overlay on the dollar index line chart is high and higher. This should have been seen with a low and a lower low in euro. This is an SMT divergence. This is a Kraken correlation. That's also indicating that this is relative strength in euro. And this was just a stop hunt on sell stops above this short-term high. That's all that is. This is a run on liquidity. And then it went lower on dollar. This low and the inability to go lower on euro, this is your SMT divergence showing you that the smart money is in fact buying in New York, and then you have the price run. So at every key turning point, you want to study and compare what the dollar index was doing. For instance, we have the low, lower low, lower low on the pound dollar. We have the high and then the lower high here. Well, it should have went higher than this one here because it went lower here. That would be a perfect symmetrical market. You want to be comparing and contrasting the highs and the lows relative to the pair that you're trading against the dollar. So the dollar, in a perfect world, if it makes higher highs, euro should be making lower lows, cable should be making lower lows. But if there's a time when the euro makes a lower low or pound dollar makes a lower low and the dollar index fails to make a higher high, that's indicative of underlying weakness in the dollar, and vice versa. If there's a time when the euro dollar is going higher and has a higher high, but the dollar index fails to make a lower low, the same thing is being said there, that you have underlying weakness in euro, even though it makes a higher high, and underlying strength in dollar because it fails to make a lower low when euro made the higher high. Now, I said a whole lot there, but if you listen to me carefully and you write down what I'm saying, those conditions are very important for understanding market correlation. If there's a break in that correlation or symmetry in marketplace, it is highlighting the fingerprint of smart money. They cannot hide it. They will never be able to hide it from you. But when you understand what you're looking for, it is like an X-ray view in the price action that sets up these nice big runs. Now, I'm not saying this is a huge run, but this is a nice run for an intraday chart. So you always want to look at your SMT divergence relative to the kill zones and the logic of what you're looking for.